Yeah. I know. We've been making a lot of money. I know. Oh, hang on. Oh, hey, welcome everybody to TradeSmith. Courtney Smith here with our weekly video newsletter, bringing the hammer to the markets for over 45 years. How is that even possible? That young-looking guy can't even be 45 years old. But hey, what can I say? This disclaimer, however, seems like it's over 45 years. What can I say? All right, let's get right into it. So, markets rallied up there. That's really helped out our positions quite a bit. Look at the purple predictor, though. The purple predictor is weakening here. So this is what I've been talking about, how the market is really going to struggle higher. It's a bull market. We're going to have a bull market this year. We're not going to have a crash. We will have a 5 to 10% correction probably in August or September. We'll see. But right now, we just have to stick with the struggling bull market mode, which has been our scenario all year long. So, markets rallied up. According to this chart, the purple predictor is saying we should get a little bit of a dip in here. Let's take a look at some other charts. Dow Jones, oh my God, the purple predictor is much worse here. So we have to sit back and say, Dow Jones stocks don't want to be there. Would rather be in S&P stocks than Dow type stocks. But guess what? The best place of all is to be back in the NASDAQ. We kept you out of the NASDAQ for several weeks, but a couple of weeks ago, we told you that this market was now exploding higher, and this is where we want to be. We want to be back in biotech, high technology, medical technology. These are the types of stocks we want to be involved in. Look at how the purple predictor is not weak here. Look at the gap that we left this week. Look at the gap we left 2 weeks ago. These are all signs that NASDAQ stocks are where the action is and where we want to be. Seasonality, also keeping us on the long side. Oh my goodness sakes. Normally it's sell in May and go away, but our seasonal indicator continues to make new highs and keeps us seasonally bullish here into the middle of July, actually the latter half of July, and that's helping us expand our profits dramatically. However, notice the purple predictor is also weakening a bit here. So that, not to say that it's going to give us a sell signal, but I think once again the IWM, which is the Russell 2000, it's going to show a little bit of weakness this week as well. Now, the seasonality. Follow the blue line. That's the best one. You can see that the dip is supposed to be over, okay? We're supposed to be rallying, which we are. But then notice at the beginning of August, which is just in a week and a half, we then go into a 2-month extended decline in the market. And that should be, let's say 3%. I would say 3% would be a good number, but it could just as easily be more than that. It could be 5, 6, 7. I don't think we'll get all the way up to 10. Now, that's the number one scenario that I'm looking at because it's all post-election years, so it has the most data. Now, the red line is the all first elected presidents, and of course, President Trump, this is his first time elected. And you can see there, it's a bit more bearish. The dip goes a little bit further in July, although we're past the end of the dip period. You can see that the rally goes a little bit further into August, but the dip is about a 4% dip into the end of September. Now, the worst scenario of all, which has the least amount of data and therefore is my least preferred scenario, is the black line, where a Republican is first elected. And in this case, and part of the reason I don't like it is because it's not working. So here we are rallying in the later part of July, but according to the black line, we should be dipping. So it's just not working. But let's keep an eye on it. If that one comes true, then you can see that from the beginning of August to the middle of September, we'd get about a 7 or 8% decline. So that would be the most bearish scenario. But because it doesn't have a lot of data, it's not as statistically valid. And that's why I prefer to go with the blue line. But the way you interpret this is you say the blue line is the preferred scenario, but that the other potential scenarios, which are the red and the black line, those are more bearish. So we take the blue scenario, which is the most preferred, but we want to kind of shy it down a little bit more bearish than what it is, okay? And that's why I'm saying instead of like a 2 or 3% dip, maybe we get a 2 to 5% or 6% dip, a little bit more, because the red and the black lines are, even though they're not as statistically significant, they're both more bearish than the base case. Now, the yield curve has been really a neutral right now. But notice, I want to go back. Notice that we're supposed to see a low sometime in September. Once again, let's stick with the blue line for a second. Notice that the yield curve starts to perk up at the beginning of September and really accelerates at the beginning of November. Now, this is from last year, but this is a one-year leading indicator. Now, what it does is it calls for major trend changes at extremes, and we're not at an extreme. So right now, because we're seeing the yield curve go sideways, we would anticipate that it's neutral to the market. It's neither going to help nor hurt. But in the beginning of September, we're going to see that yield curve really take off from the 120 level all the way up to the 210 level, which is going to provide some extra tailwind to the bull scenario. Asset allocation. Well, after perking up quite a bit, it's kind of faded here a little bit. So I'm going to call this a neutral. The market risk indicator also kind of moved to neutral after having been bullish there late in June. Our global shares have perked up. They're actually showing more strength now than we see in the S&P. Now, I don't have any position here really in these global shares. I'm focused more on emerging markets. And this is where I think there's even more action, and this is where I actually have real trades on in the real world. Now, Greece, of course, has been it's kind of a European, but it's also kind of an emerging market. They've gone backwards so much, I think they left the first world. I'm not sure. But anyway, you can see we've got a little bit of sideways price action here. But all in all, this is going to still be the strongest market around, maybe in the whole world, in the developed world. Bonds are going up. That means lower interest rates. And look at the purple predictor. The purple predictor has I pointed this out a week or so ago. I thought that we would actually trade down. So I was wrong with my scenario. I thought we'd get up to the top of the gap that we left in early July and then start to fail. What did we do instead? We gapped above the old gap. And that's called an island reversal. And it's quite bullish. And the purple predictor is quite bullish. And this would all suggest lower interest rates. Now let's take a look at our key indicators. The green line you can see it hooked down sharply. That means lower interest rates. But the gold line went up, suggesting higher interest rates. And down at the bottom, the chart of the CRB, it went up, suggesting higher interest rates. But the key factor right now is the blue line, which is 10-year yields in Germany. In other words, the U.S. and Germany interest rates are going mainly in lockstep right now, and that's the biggest factor, and that's why we're seeing those interest rates go down. Now, if interest rates are going down, then the dollar should be going down, and look at what it did on Friday. That's called a key reversal day. It's an outside day and a reversal bar, very, very bearish. You know, I turned bearish a few weeks ago. I am remaining bearish, and maybe I'm getting even more bearish because the technical price action is getting worse. So, got to stay short the dollar. Now, if the dollar is going down, then gold should go up, and indeed it is. But here's what worries me. Why isn't it going up more? In other words, I'd rather be short the dollar than long gold, except for one thing, and that is I'm calling for a major bull market in gold to start right about now. And what I've done is I've put together, I'll tell you in just a second, but look at our indicators. They're mainly bullish gold now. So look for gold to move higher. But furthermore, here's what I want you to do. I'm putting together a live webinar for you. It's coming up on July 31st. And the subject is massive rally coming in gold. And I'm going to explain why I think that's the case. I'm going to give you the background in depth of why this bull market's going to come. And once you've seen that, I really want you to see it. I'm going to update that scenario here in TradeSmith. So if somebody wants to know what what I think on a week-by-week basis, they've got to be a subscriber to TradeSmith. Well, you're already a subscriber to TradeSmith, so you're very lucky. But I still highly recommend going to the webinar. So, because I'm not going to go into the deep background here in TradeSmith, I'm going to do it on the webinar. Now, I'm going to send you out an email with an invitation to it. All you have to do is click the invitation. It's absolutely free. So please come to the webinar to get that deep thing. It's going to be July 31st. I believe it's going to be at 5 p.m. Pacific time. It's going to be probably 45 minutes long, but I'm going to go into gory detail. I'm going to teach you how to analyze the gold market. It's going to be really worth your time. And as I say, it's free. And as I say, monitoring and keeping up to date on this mega strategy is going to be here in TradeSmith. So you're very, very lucky. Oh, I should say in the fully paid up version of TradeSmith, but we will touch on it here in the freebie version as well. But please also become a fully paid up member. Now, oil, we got the rally, and now we're cracking down again. And you can see we're forming what's called a wedge formation. Volume is confirming the wedge formation. This would be bearish and would call for the market. If we break that uptrend line, it'll go back down towards 42. All right, that's it. Of course, freebies, we love having you here, but you really should subscribe. It really is worth every nickel. Less than a Starbucks coffee every day. Plus, we now have our mega strategy in gold that you're going to want to get my specific trade recommendations and the monitoring and the changes of stops and the pyramiding. That all comes in the fully paid up version. So please check it out. And for all of you fully paid up members, just hang in there for just a second.